Thank you for staying. I'm Amanda Smith, and I'm an extension economist here in Tifton, and I'm going to talk to you about the inputs outlook, and at the end, we're going to go over the crop comparison tool. And I don't have a clicker, so I'm going to have to move the slides from here. I always like to talk about the macroeconomic environment going into 2024, and what we are seeing is a slowdown in the GDP for the global economy. If you look at the U.S., actually, 2023 was better than expected with an estimated 3.1% growth. We just had a little bit of growth every month, and that accumulated about 3.1%. And that was just consumer spending as inflation started to ease a little bit throughout the year. But the Eurozone definitely struggled in terms of growth. And projection for 24 is the U.S. and China will be down, as well as the rest of the world. In addition, there's further risk to the downside to global growth. You'll note that last bullet there, the geopolitical conflicts. The Ukraine, we're coming on almost 2 years of the Ukraine war. And so the markets have really kind of absorbed that, and they're not as volatile due to changes there. But Gaza, when Palestine invaded Israel in October last year, that caused some shocks to the market. And then currently, the conflicts in the Red Sea are creating more issues with Houthi attacks. The Yemen-based Houthi rebels attacking shipping containers. So that's increasing shipping costs and the time it takes for shipping containers to get to where they need to go. And so that is putting added pressure on inflation. Furthermore, commodity prices are down. This chart is from last Monday, so it's a little bit dated, but the story that it tells is the same story. Corn, cotton, soybean, wheat prices, they're all lower than they were from 2022. And the other thing that it tells us is that they're not as low as they were prior to the pandemic and when the last farm bill was written. So you'll note that government payments are not expected from the Farm Bill safety net because reference prices are not near what prices are currently. So current prices are not low enough to trigger reference prices on potential base acres for the PLC program. So that Farm Bill safety net is not going to be there. Furthermore, from a trade standpoint, trade is really, really important for cotton. We export a lot of our raw cotton product and then import cotton, value-added cotton. So imports and exports, trade really matters for the cotton industry. The orange line is looking at imports and the blue line is looking at exports, and in general, trade has been down since 2022. We also look a lot at the US dollar and the impact of that. When the US dollar is strong, it makes our exports more expensive to other countries, but also something unique for cotton. When the US dollar is strong, it increases consumer confidence and people tend to buy more cotton products like linens, clothing, upholstery, and things like that. So there's a little bit of give and take there in terms of cotton, making it unique. This is just to show you how shipping container costs have increased. They've come down significantly from the backlog that we had after the pandemic in recovering from that. So this is January 2022 through the end of 2023. And you can see the latter part of 2023, that shipping container cost doubled in cost. So certainly adding to inflationary pressures is also adding to the amount of time people have to wait for products. Just today, a headline in the Wall Street Journal was talking about Walmart and Adidas are burdened by the added time to ship products because they're diverting the ships going to the Cape of Good Hope around Africa. So inflation continues to be an issue. It has improved, but there are some risks to that because of oil price volatility and the shipping container costs. Tied along with that, we have the higher interest rates. So the Fed steadily increased interest rates, and that was working to move inflation down. So rates now are the highest they've been in 23 years. The outlook is that maybe by the end of 2024, maybe quarter 3, quarter 4, the Fed might revise them down. They met today at 2 o'clock, and I didn't check to see if they decided to keep them steady, but I think their plan was to keep them steady. Okay, good. So, plan to keep them steady for now, maybe not so good if you're paying those interest expenses. The farm operating notes we're looking at averaging between 7 and 9%. So, you know, if they decide to make some cuts the latter part of 2024, it's not going to affect this operating year. So interest expenses are going to be another big expense for farmers in terms of their cost of production. The Farm Bill, talking briefly about that, mentioned a little bit on the other slide how reference prices are above the low cost of production and commodity prices are not that low yet. So there is some discussion about, hey, can we revise the reference prices to at least meet the cost of production to help growers break even? But Austin Scott last Friday was at the Ag Forecast, and he said there is a segment of legislators who are strongly opposed to an increase in reference prices. And then Chairwoman Stabenow from Michigan, Senate Ag Committee Chairwoman, is trying to look at options in terms of crop insurance and maybe expanding those opportunities for covered commodities. But as one producer told me, he said, well, you know, Amanda, we have to pay for crop insurance. We don't have to pay for choosing our real PLC on base acres. So this is just to reflect how prices or how expenses changed in 23 compared to 2022. The dark blue is 2023. And we saw increases in labor, seed, interest, taxes, and rents. The big one there is interest expenses, 43% higher than 2022. And I wish I could tell you that we could see a big change down for 2024, but it doesn't seem like that will be the case. So we'll probably see that about even when we're looking at 2024 compared to 23. The good news is we saw fertilizer, pesticides, and fuels come down, and also feed. So if you're diversified and have livestock and poultry, that's good news on that cost of production, but not so great if you're growing cottonseed for feed or corn and feed grains. All right, so what are lenders concerned about? This survey is conducted in August of every year and is published in November. So the top concern for lenders is liquidity and the ability for farmers to pay current debt that's due within a year. And this is true here in Georgia. We published the crop comparison tool online, and I had a banker call me and say, Amanda, I'm working with a borrower, and where we're located, we've got really sandy soil, so our costs a little bit higher. We're putting in a little bit more fertilizer, a little bit more irrigation, but otherwise they're pretty close. And this borrower's told me what he's paying for land rent. And I'm thinking that he's gonna barely break even. So obviously that lender is concerned about liquidity and the working capital of that borrower. Farm income levels are second, inflation, because cost of production is inflated, and it's just, they know that those costs are there. Weather 4, and number 5 is labor. And Zippy Duval at the American Farm Bureau convention in Salt Lake City just the other day said that labor was the #1 issue facing agriculture in the United States. Land is a very, very important input, not just because we produce our agricultural products on it, but also because it's collateral. And we actually saw land values increase almost 10%, 9.8% in 2023 compared to 2022. And this is a surprising increase to me, given the high interest rates. I wasn't expecting that big of an increase in farmland values. But people have various reasons for investing in land. Maybe they're looking at investing in land to develop it or rent it out to others or farm it themselves. The other thing that we saw was that cash rents also increased, and We saw the state average for cropland increase $22 per acre and irrigated $13 per acre. Note that these are averages for the state of Georgia and conducted by the USDA National Ag Statistics Service. Georgia is a big state, so keep that in mind when looking at these numbers. Big from north to south, very diverse from north to south and east to west. So you may be paying above or below that in terms of your own personal land rent. So this is just a good average number to kind of look at. Sometimes I tell growers in the southern part of the state who may be paying a little higher than that for irrigated or not irrigated cropland that maybe this is a weighted average for owned versus rented. And then also I just want to put a plug in for aglease101.org. If it's time for you as a grower to renegotiate land rents, there are some fill-in-the-blank lease agreements and chances to enter into a flexible lease agreement where the owner and borrower can both benefit when times are good and both take on the burden when times are tight like this year. Just the big takeaway for oil futures, or oil and farm diesel, prices are down from where they were. I'm using $4 a gallon in the enterprise budget, and farm diesel ranges anywhere from $3.80 to $5.20 a gallon. So if you have some on-farm storage and you're able to take advantage of some of those lower prices, I recommend that you do that because the outlook for oil is for increased volatility in terms of those prices. The good news on the fertilizer side is those prices are all much lower than they were back in 2022, in early 2023. The blue boxes you can see for N, P, and K are current prices for those, relatively current prices. And note that I've got a little bit higher than that for in the 2024 enterprise budgets. So I anticipate usually we see an increase in demand prior to spring planting. So there's a little bit of cushion here to anticipate that increase in demand. But really the outlook for fertilizer prices is for those to stay low. And that's because corn prices are projected down. And there's over a 90% correlation between corn price and the price of nitrogen. So there's the overall outlook for inputs for 2024. And I will go ahead and turn the program over to Dr. Liu.
All right. Thank you so much for staying. This afternoon I want to update with you guys about the 2024 cotton outlook and some economic factor producers need to consider for the rest of this year. When we first start talking about cotton outlook, the first thing we need to review is what happened to the cotton market in the past several years. So this graph shows you in terms of pre-pandemic, pandemic, post-pandemic, what happened to the cotton prices. So pre-pandemic, the cotton prices were ranging around middle 70 cents per pound to upper 70 cents per pound. And then during pandemic, there were periods of time that everybody had lockdown and then shopping mall has been closed. The price dropped significantly. And then afterward, economy doing really well and the cotton prices recover. And during a period of time, we are experiencing historical high cotton prices, over $1 at the peak of over $1.40 per pound. And then after that, market quickly drops back to what I call what's going on right now as a market stabilization period. So during this period, cotton prices kind of follow global supply, global demand, global economy, as well as domestic U.S. supply and demand. So now let's take a look at what is going on for the economy globally. Amanda laid a very good foundation about the global economic growth for the major country in the world. This graph shows you in terms of the overall global economic growth in the middle of the line at 2.9% forecast by IMF. And then the lower line on the bottom is the advanced economy, including US, Europe, and all the other advanced economy in the world. and the top line are emerging countries, Asia, Africa, etc. What is showing on this graph is IMF every year gave up economic forecast for the coming year in April as well as October of the year. This one is from October. The number has been adjusted down from their April forecast. So IMF are projecting this year economic growth going to be slowing down for this year. Why that matters? Because cotton and cotton-related products are discretionary items. When the economy are doing well, consumers purchase more goods, purchase more textile and apparel products. When the economy is doing not that good, consumers tend to shrink in terms of those purchases. So that is what we say historically on the cotton market. Now let's take a look at in terms of U.S. economy. What U.S. economy actually doing really good, better than expected. There are lots of people. There was some discussion whether we're gonna enter into a recession for the past year and whether we're gonna enter into a recession for this coming year. But the economic data shows that we have, for all the quarters in 2023, we have positive economic growth for all 2023. We might experience a short-term recession during the first and second quarter of 2022. The economy since then has been on a positive trend. So that shows that Fed was effectively in terms of control the inflation as well as not put our economy into a recession for the U.S. economy. When we talk about cotton and cotton-related products, we have really take a look at in terms of consumer income, consumer spending, as well as how much money is still left in the consumer's pocket in terms of saving rate. So this graph is real disposable personal income for everybody in the U.S. The real term means inflation has already been adjusted, taken out of the equation. That shows long-term projection of the income growth without taking the inflation factor out. That shows the real money that you have been making. So overall, consumer has been making more money. For everybody in the U.S., there was a period of time during COVID because of labor shortage, personal income rise very quickly during that time, but now the trend is still upward trend. But what I really want you to compare is the next graph, is consumer spending for everybody in a real term. That is adjusted for inflation as well, taking inflation out of the factor in real term, how much money we need to spend to sustain the household. So what we see is after pandemic, consumer spending has been rising up. If we compare the consumer expenditure with the income, you can see consumer expenditure are rising at a much higher rate than the income. That means you have to spend, you earn less money, but you have to spend more money to sustain your household for everybody. As a result, the personal saving rate in the U.S. are at a historical low level currently, and it has been trending downward for the past several months. If we compare right now with the pre-pandemic level, personal saving has dropped significantly. Then if we compare during COVID, because of lockdown, we have limited opportunity to go to the restaurant. We have limited opportunity to go to shopping malls. People really saved a lot of money. And that is one of the factors why we have seen the rising of the cotton market during this time, because you cannot go to restaurants, cannot go travel, you buy stuff. Buy clothes, buy toys, subscribe for different type of movies at home. And that is one of the major factors driving the demand for cotton and cotton-related products and driving the demand for U.S. cotton during that time, because people have so much money saved. But right now the story kind of reversed. People need to spend more money to maintain the household. People earn income in real term is not rising as fast, and we have less saving rate. So in this coming year, the purchasing power of consumer into the textile apparel is declining than previous years. Now let's take a look at, in terms of global supply, global demand for cotton for the last season, for the 2023 crop. Meal yields has been upward a little bit compared last year. Currently forecast at 112.4 million bales globally. Compared to what happened for the 2020 crop year, marketing year, the global capacity, that is actually one of the record year for total global demand at over 124 million bales. That shows the global capacity that we were able to spending that amount of cotton and also making into textile products. And right now we are significantly lower than those years. What is holding the cotton market for this past year, current cotton market, is really because production are down for 2023's crop compared to previous years. One reason is unfavorable prices during planting season for 2023. Another reason is there are some weather issue challenges happen globally, declining our cotton production. Without the lower supply, we won't be able to say what the prices we have currently at over 80 cents per pound. Now let's take a look at, in terms of where cotton getting planted and coming from. Those are the top 5 cotton producing countries in the world: China, India. United States used to be the number 3 cotton producing country in the world. But last year we have some challenges in terms of weather issues, especially drought situation in Texas, really declined our total production. Last year we produced at 12.4 million bales, but Brazil really catch up for the past several years in terms of their total production. They are producing 14.6 million bales. Why Brazil matters? Because that Brazil is a major competitor with U.S. cotton on the export market. So let's take a look at where crop is produced in Brazil. Those are the 2 major regions of cotton produced in Brazil, one in the central region, one in the eastern region. Historically, the cotton got shipped to the port around this region to get exported. Because of some infrastructure challenges for the middle of the region, it's difficult to ship the cotton to this port. But Brazilian government are working on some infrastructure project to try and open up new port on the red corner over there to make it more efficient to transport and ship cotton and ship their agricultural product by building new port to other countries. So if they finish those projects, that will make Brazil make it very easy for them to export their agricultural product, and then they will compete with U.S. cotton on the global market. Brazil have a lower cost of production, and they have a different type of regulation than the U.S. to produce different type of agricultural product. If they become more efficient, they will continue to be the major competitor for U.S. cotton. And this one shows in terms of the global exporters by country and by year, showing who are the major players in the export market globally. U.S. still is the largest exporting country. For the 2023 crop, last year we expected to export 12.1 million bales, and Brazil for the 2023 crop I expect to export 11.5 million bales. Almost catch up what we are exporting in the U.S. That shows how much of the competition there from Brazil. Now shift gear a little bit and look at domestically in the U.S. for cotton supply, demand, as well as ending stock. For the 2023 crop, demand is higher than production. The orange line is demand and the blue line on the top are production. So demand is currently projected at 14 million bales, and production is at 12.4 million bales. This gap of lower supply, higher demand, what is the major reason sustained our cotton prices at over 80 cents per pound for the past season. For this coming year, there's really uncertainty over there because global demand are expected for cotton are expected to stable but a little bit lower than what we see for this past year. And the real question over there is how much of supply both in the US and globally for cotton. Then we will see what the price projection will be. Overall, the ending stock in the US have been trending downward because of we have lower production. So what are the causes for lower production? This shows the projected planted acre, harvested acre, and yield per acre for the harvested acre. For 2023 crop, we planted significantly lower than last year, and it's actually one of the lowest years for the past 10 years. We planted 10.1 million acres compared to last year, or 2022, at 13.6 million acres. And the harvest acres are down as well, 6.9 million acres compared to 2022, 7.1 million acres. One reason why there's a very big gap over here around 3 million acres is because Texas drought situation really happens, and there is a lot of abundant acre in Texas. And that is the reason why in January, USDA forecasted the total US cotton production at a lower level, adjusted that number down. And that is one of the reasons why we see cotton prices jump from the upper 70 cents per pound to middle of the 80 cents per pound for the last jump because of the limited supply. For the acres that got harvested for 2023 crop, yield is projected down, but it's still higher than 2021 crop, and it maintains at relatively the historical average level, currently at 841 pounds per acre compared to last year of 945 pounds per acre. This shows in terms of the U.S. Total export and export market share globally, and also export as a proportion of total U.S. production. The export has been trending downward. One of the reasons because we have lower production for the past several years because of weather challenge. When we have lower production, we tend to export less. So current year for the 2023 marketing year are projected at 12 million bales compared to last year 2022 crop 30 million bales. And because we have lower export number, we have lower production, we have lower export number, our proportion of export to production rises up. It's over 100%, so we are exporting more than we produced last year. Historically, on average, over 80% of cotton produced in the U.S. enter into the global market and export to foreign countries. And the bottom here is really important part. That shows the market share of U.S. cotton on the global market, on the export market. We have been trending downward. For the last year, it's at 28% global market share, compared to historical high at around 40% of market share. Why this matters? Because trade is a relationship. Once you lost some market overseas, it's kind of difficult to gain those markets back. It takes time for the relationship to rebuild, and also take time for us to be competitive with that relationship. So the lower market share, it definitely created some challenges for the export, U.S. cotton export. Now shift gear a little bit towards what is going on in Georgia cotton production. So since the 1980s, cotton production in Georgia has been trending upward. Last season, we produced a little bit lower than the 2022 crop, but still at a relatively high level, 22.25 million bales produced in Georgia compared to 2022 crop, 2.65. That is actually one of the high level in history. So, a lot of producers and agents have been asking me, Serena, when do you see cotton prices go $1 again? Every time I heard about this question, I'm like shaking my head. I don't want to keep their hopes down, but really, when will the cotton prices go $1? So this is what the cotton prices for the past 20 years. I pull the data from, and then I draw a line for when the cotton prices reaches $1. Only 2 opportunities for the past 20 years cotton prices got over $1. One time is around 2011 to 2013 period. Another time is right after we recover from COVID. What happened during these 2 periods? So for the 2011, 2013 time, during that time, Chinese government bought a lot of cotton from the market because their domestic price support program set up price floor too high than the market price. So they bought those prices to support their domestic cotton farmers and bought a lot of cotton out of the market. That pushed the market up during that time. Will China do that again? Probably not. So that probably be a one-time opportunity or one-time policy change during this period. For the second period of time, right after COVID, as I mentioned earlier, their consumer demand, because they have so much money in the pocket, in terms of saving, cannot spend for travel, cannot spend for food, restaurant, they buy a lot of product. Demand for apparel and textile product up, that pushes cotton market up a little bit. And then the second reason is we faced some supply chain issue during that time. As Amanda showed on her cargo graph, during that time around early 2022, cargo prices are over $8,000 per container. During that time, because the price is so high, a lot of ships leave the U.S. empty, going back to Asia, trying to go back to Asia as quick as possible, load with full cargo, come back to the U.S. to earn those high shipping rates. And that left our agriculture has some challenge. They just sit on the port, unable to get to the customers. We produce a lot of cotton during those years, but those cotton were just not able to go to the mill, not able to go to customer. So our customer, they have one side have high demand for cotton, and they have to be facing their consumers. Another one, they have limited input during that time. So they made cotton as much as possible to keep their factory running. And that is another reason for this peak of prices. During that time, we also facing some challenges in terms of labor shortage at cotton gin, delay ginning, as well as classing office, unable to get the cotton classified, and those cotton will be able to enter into the market to get sold. So various factors for the second peak. But that tells us some stories. Will those 2 things happen in the future? Unlikely not. So that tells us the price expectation for this coming year. So I pulled the data for the prices, different future prices for the old crop as well as new crop here yesterday. So what the prices from the chart showing for the new crop prices are trending around 85 cents per pound. And for the coming year's new crop, prices are trending around 80 cents per pound. What is the difference between here is really what we can see from here is market are telling us the prices are trending downward. Historically, pre-pandemic time, there's a reverse relationship. The more current old crop traded at lower level, new crop traded at relatively high level in terms of prices. Why that happened? Because there's uncertainty in terms of production, whether the risk factor built in, so prices for the farther futures has been traded a little bit higher than the current futures. But during COVID and during the time we have peak of cotton prices, this reverse relationship happened. between the old crop and new crop. That is really the market are telling for this new season. The market doesn't expect prices as high as what we are seeing right now. So shift gear a little bit to some factors producers need to consider for 2024. One part is inflation. As Amanda mentioned, that Fed were able to control the inflation. The inflation has been eased from the peak of 9.1% to the current around 3%. What concerns me a little bit are this upward rising in December of the inflation rate. That gives some concern for the Fed. They might not be able to reduce the interest rate as early as what they expected. So we might see the interest rate to continue at a relatively high level for a longer period than expected before. This graph shows in terms of what is the interest rate rise that Fed has been implementing since 2022. What we are seeing is Fed has been increased 11 times in terms of interest rate, trying to fight inflation, and the current rate, target rate set by Fed is 5.5%. Fed has been signaled before the data of December inflation rate has been released, signaled 3 different times of rate cuts coming in 2024, but it's during the late of 2024. But after the new data showing there might be some delay in action, back in terms of increase in decrease in interest rate. Another factor we need to consider are U.S. dollar index. Why that matters? Because as I mentioned earlier, 80% of cotton entering into the global market export to foreign countries, and $1 got appreciated. That means our foreign consumer view cotton as more expensive product. $1 got depreciated, our customers will be able to purchase at relatively lower prices. So what we are happening here is, even though the prices has U.S. dollar prices has been dropped from the historical high level, but it still maintained at relatively high level pre-pandemic. So this will create some challenges in terms of the export market for U.S. cotton. The next one is the cost of production for cotton in 2024. This graph shows in terms of the variable cost and the fixed cost for for Georgia cotton producers from 2021 to 2024. This half is the irrigated land, and the next half are the dry land production. What we can see from this graph is cost of production for 2024 are expected to go a little bit lower than the peak of 2023, but they still maintain at relative high level compared to 2021. So cost of production is still high. Then what does that mean for producers? For producers, if we are assuming 1,200 pounds per acre of yield for irrigated land, and then 750 pounds per acre for dry land production, how much money producers need to sell their cotton in order to break even for both variable costs as well as fixed costs? If they want to break even for total costs, including variable costs and fixed costs, producers need to lock their cotton for irrigated land at 88.1 cents per pound. And then for dry land, at 750 pounds per acre, they need to lock over $1.03 per pound for break even, including both variable costs and fixed costs, to sustain long term in terms of production. For variable costs, if they want to break even at 55.5 for irrigated land, and then 71.2 cents per acre per pound for dry land. The variable costs, including cost for planting, growing, harvesting, and marketing, that is just sustained for short term. But over a long term, producers really need to pay for the depreciation, for their management. So trying to maintain into the business really need to either be able to find some market opportunity catching the peak of cotton prices, or need to find some way to reducing the cost or improve yield. Really quick about some updates on the policy side in terms of ARC and PLC. There was a law signed last November extending the Farm Bill for another year until September 30th of this year. That gave producers opportunity to sign up for ARC and PLC, and the deadline is March 15th to work with the FSA office to sign up for ARC and PLC. Every year I got a lot of questions from agents and producers about when I expect to get my ARC and PLC payment, if there's any. And I got this question so often, so I made the chart to make it clear for me to explain. So right now, we are at the beginning of the year 2024, enrollment and also election enrollment is at the deadline at March 15, and then we are going through the entire marketing year for the 2024 crop. The end of the marketing year for 2024 crop and on July 21st of 2025. After that, USDA gonna release a lot of yield data, a lot of data for the ARC and PLC program. The real expected time for payment after October 1st of 2025. If the Farm Bill program are able to continue running, there's some uncertainty about what's going to happen, what is going to happen with the payment after September 31st of this year. But if there's nothing changes, the program keeps running. If there's any payment for ARC and PLC, that will be after October 2025 for this year's crop. Some people ask me about which choices to make. For PLC, there's some challenge in terms of getting payment based on the current market price. The current market price at 85 cents per pound per lint, and then around 160 to 180 dollars per ton for cotton seed. We won't be able to see any payment for PLC. For ARC, there's some opportunity to see payment because prices are trending downward for cotton prices, and the high historical prices are favoring, are increasing the benchmark prices for ARC. But what is really can help producer get some ARC payment is really depends on weather. But we don't want the severe weather issues to decline our yield. So there's not that many chances for ARC to pay, but PLC has near lower chances. So Texas EM developed some ARC and PLC decision aid tool. Those two are very friendly to use and recommend producers to use them. Some election consideration in terms of ARC and PLC enrollment. If a producer enroll in ARC and PLC, the farm is not eligible for STAX. But STAX is a relatively good program because 80% of the premium is getting subsidized by the government. So some suggestion is if a farm don't have much seed cotton base to enroll in ARC and PLC, definitely consider STAX. And if a producer enrolled in ARC, the producer on that farm is not eligible for crop insurance for ICO. But regardless of ARC and PLC enrollment, the farm is eligible for ECO program. I put some data in terms of the cost for STAX. So some people are making the decision between ARC and PLC as well as STAX. ARC and PLC are free programs for producers to enroll to do some risk management. STAX is a good program, but there's some premiums for producers. So this is Burke County. There are some basic assumptions: 1,000 acres, 70% coverage level for their companion insurance, that including yield protection, revenue protection, and revenue protection with harvest price exclusion, or producer don't have any other insurance purchase. And also 1.2 protection factor. The premium ranges from 1.6 for 75% coverage level to over $8 per acre for 90% coverage level. From the data pulled about stacks enrollment, most producers enroll in 90% coverage level for stacks. Here is some information about crop insurance for sales closing date and cancellation date. If you want to purchase crop insurance or cancel the current crop insurance, the deadline in Georgia is February 28th. And there are all the crop insurance available for cotton that is summarized in this table, including deep loss program. That means if there's a complete loss for the farm with zero yield, all those losses will be covered. Those including yield protection, revenue protection, and revenue protection with harvest price exclusion. On there, those are all individual programs based on each farm's historical yield and historical revenue to calculate the individual farm's program. And the trigger are either the farm's yield or farm's revenue, and that can be purchased as a standalone product in other products to be able to purchase. And then there are also shallow loss programs in crop insurance. That means it covers a certain level of the losses, but they won't cover after that when the yield gets lower. Those including ECO, SCO stacks, and stacks with harvest price exclusion. For SCO, ECO, those requires companion policy. Those requires yield protection or revenue protection to be able to add those on. So you cannot purchase ECO and SCO by itself. But stacks, it can be act as an add-on product, or you can purchase stacks individually. So you can purchase a yield protection and then add stacks, or you can just purchase stacks without the yield protection or revenue protection. There are other additional programs which got used by producers, some area freeze protection. Some people in this past season and recently have been looking more closely on hurricane insurance protection wind index to mitigate some risk in terms of hurricane. This graph shows the projected price and harvest price for cotton each year during the time in Georgia. Its projected price discovery period is from January 15 to February 14, and after February 14 we'll have a better idea what is the projected price for giving a baseline in terms of price protection, all the price that is protected by crop insurance. And then in Georgia, harvest price discovery period is in October. This graph shows is the harvest price divided by projected prices. When there's a line of 1, when the bar goes over 1, that means the harvest price is higher than projected price. For the past 14 years, there's only 4 opportunities that harvest price is higher than projected prices. So that gives producers some idea in terms of looking at crop insurance, because both revenue protection as well as stacks giving the opportunity of harvest price exclusion. Those policies usually a little bit cheaper than the one without. So that is a graph I want to show here. With that, any questions? That's the end of my presentation. No? If not, I saw Miranda just walk out. She wants to update on the crop comparison tool. We are using. So this is a nice tool developed by UGA. I hope she'll come back soon because I'm really not an expert on this. We are using to compare between different crops, including cotton, peanut, soybean, and grain sorghum, to see with the historical yield or expected yield and expected price, which crop is more profitable, to help producers making decisions about which crop to plant. So here, see if we have currently cotton yield at 1,200 pounds, peanut at 4,700 pounds, and then corn 200 bushels, and soybean 60 bushels, and grain sorghum 100 bushels. With the current prices, the cotton prices I put there is a little bit low here, but with the current prices listed here, if we want to compare about the break-even prices, it shows like soybean, yes, life-saving.
Perfect timing.
Yeah, perfect timing.
Yeah, so this, the crop comparison tool that we've got pulled up here, sorry my voice is cutting out on me, is based on our UGA row crop enterprise budgets, and you can Google it through ugacropbudgets.com. Or, I mean, just Google UGA crop budgets and it'll pop up. But what we have for yields there are based on budgeted yields. So I recommend that everyone adjust the yields to be reflective of what they typically get in fields that they're looking at. So we've got irrigated cotton at 1,200 pounds, non-irrigated cotton at 750 pounds. The prices that we have there, I'm gonna change this one. So in blue, those are harvest time futures adjusted for basis. And that's because, you know, for those we pretty much have futures options that we can look at. Grain sorghum is basically a percentage of corn. And then peanuts, we don't know what peanut contracts are going to be. What I did there to come up with a price was, say, $5.25 a ton on 50% production, and then $500 a ton at harvest price. So that would be the remainder of production, and that would happen if we planted more acres of peanuts. So, not sure exactly what's going to happen there. When making the year-to-year planting decisions, growers need to look at this return above variable cost. I call it also contribution. This is contribution to family living, contribution to any principal payments on debt that you may have, and so on. So you definitely want to have a positive value there because you need to be able to cover what it costs to plant, grow, harvest, and market the crop. Now, if you recall, we had state average values for land rent. And when Dr. Liu showed you the cost of production slides for cotton over the past several years, she said that was on owned land. So I'm just plugging in the USDA National Ag Statistics Service state average value for land rent for us to take a look at these numbers and see how it changed, because this tool also helps calculate break-even price and break-even yield. So in this situation, we would need to market all of our cotton at least 80 cents per pound. And if not, then we need, and that's at 1,200 pound cotton. If not, then we need to shoot for a yield of 1,225 pounds per acre on that irrigated cotton. For non-irrigated cotton, we're looking at a break-even price of 88 cents a pound. And that's with land rent at $75, or maybe that's a weighted average cost of capital in owned versus rented land, or 840 pounds per acre to cover those break-even costs. So this, you know, the borrower phone call about concern about the land rents, it's not just here in Georgia, it's in the Midwest too. A couple of our colleagues in Ag Economics were doing a podcast and said, corn and soybean farmers are out of the University of Illinois. Corn and soybean farmers are going to lose $160 per acre. And my drive drops while I'm listening to this podcast. I'm like, if they can't make it work, we're in trouble. But they also continue to say on rented land. And I was like, oh, okay, that makes sense. So cash rents are very high, and it may not be feasible to make a positive margin on rented land. So hopefully, negotiations can be made, or we can make enough positive margin on the owned land to cover those losses and help us survive through this year. And hopefully 25 will be better with lower interest expenses. Just to show you too the functionality of the tool, recall that I've got slightly higher fertilizer prices than current. So at the bottom of the tool is a little footnote that says what they are. So we can change those. Just to see, and pennies matter. So if you're able to buy ahead or book at lower prices, the big thing is to definitely take a look at the budget and adjust the cost to reflect what your costs are and your management practices. You know, keep it in mind depending on where you're located. The banker from Southwest Georgia, far Southwest Georgia, sandy soils. We've got more irrigation. We put out more fertilizer. So, something to keep in mind, and just know this is available if you Google UGA crop budgets. Any questions or changes that you'd like to see made to the tool? I'm going to scroll so we can drive into it. I'm not sure if I put my rent on the wheat. Well, thank you so much for sticking around and attending the session on econ. Let us know if you have any